If you have a private hospital plan in Singapore or you're planning to buy one for yourself or for your kid, then listen up because MOH has changed the entire hospitalization riders landscape in Singapore. And this may affect you positively or negatively. So this announcement and update was released on 26th of November 2025. But to my surprise, even till now, I have been meeting a lot of parents and individuals and most of them aren't aware about this new update. So if you have family members who have a private hospital plan or they're planning to get one, you might want to share this video with them because they need to understand what is changing, why it's changing, and how it affects them moving forward. So the key idea is this. From 1st April 2026, almost all the current riders that are sold by insurers in Singapore will stop selling. And I know what you're thinking. Does this mean that my rider will be cancelled? Or do I need to rush and buy before April 2026? Or is this just a way that the government is trying to make hospital insurance useless? And what is even a rider? Well, if you have any of these questions, today I want to slow everything down and give you the clarity. So by the end of this video, you will understand exactly what these changes means to you and how it affects you. So I will be categorizing you into one of these three different groups. Number one, people without health insurance. Number two, people who have bought their hospital plan before 26th of November, which is this MOH announcements. Or number three, you belong to these people who have bought after 26th November 2025, or you are planning to get one before 1st April 2026. So we'll be talking in details, but I also put in the official MOH announcement link inside the description for you to refer to. Before we talk about any of these changes, the policies, the deadlines, we need to understand the basics. Because once you understand how hospital bills are actually paid in Singapore, then everything else will suddenly make sense.
I see.
I'm just like you previously. When I first started managing my own insurance, I know nuts about it. I only understand broadly. But when it comes to the fine print, when it comes to changes, I wasn't very sure of it. But don't worry because today, I will break it down easily for you. And if you already understand how hospital bills are broken down and exactly how your insurance actually start paying, then you can actually jump ahead into the latest segment where you belong to which category. Just start watching from there. But for most people, this is where the confusion starts. So let me just begin with the basics and walk you through how hospital insurance actually works and play a part in Singapore. In Singapore, our hospital coverage works in layers. You got your MediShield Life, you got your integrated shield plans, and finally you got your riders. So the first layer is MediShield Life. Everybody has this. Okay, not literally everybody, but for Singaporeans and PRs, we have to buy this. This is our national health insurance and it's paid using our MediSave. That's why you might not be aware about these payments you have been going on. And this is good because it helps you to cover the large hospital bills, especially in the subsidized wards. That is your B2 or your C wards, where you actually share your hospital staycation with up to 6 to 8 people. Then comes the second layer, the integrated shield plan or your IPs. This is where your private insurance sits on top of your MediShield Life. So think of this as an upgrade. If you're hospitalized and you do not want your recovery to be disrupted or be affected by the people around there, and some of them can be noisy and rowdy, then this is where people would like to get an integrated shield plans to upgrade their wards to a higher class or to have access to private hospitals. Then comes number three, the third layer, your riders. A rider is optional. It sits on top of your base hospital plan or your IPs. So just let me use this simple analogy. Imagine going to McDonald's and you want to order a Big Mac. So your integrated shield plan is like Big Mac itself, the burger. You can either order it a la carte and that's perfectly fine. But most people will choose to upgrade it and choose a meal instead. You get a drink, you get the sides to make the whole experience and your meal more fulfilling. So in other words, the rider is the top up that you do to turn your a la carte burger into a meal. And different insurance companies offer different set meals. However, the rider that MOH is concerned about are those that reduce your cash that you need to pay out of pocket. And one thing to remember is this, riders are always paid in cash, not your MediSave. That's why MOH wants to do something about this. When people around you say that they have a hospital plan, they're not talking about their MediShield Life. What they actually mean is, I have an IP and maybe I have a rider as well. Now, here's the important mindset shift. Hospital insurance is not meant to make your hospital stays free. It's meant to stop making a hospital bill from becoming a life problem. And now that you have understand what each layer does, the next question to ask yourself is this. When a real hospital bill comes in, when do you actually have to start paying your cash? So let me explain this from your wallet's point of view. Imagine this, you go to the private hospital. It could be a surgery, it could be a serious infection, or it could be a short ICU stay. Whatever it is, before the treatment even begins, hospital usually have this SOP where they have an estimate of the cost of this procedure. And for private hospitals, once the estimated bill is high enough, it is very common for them to ask for a deposit or a financial guarantee upfront. This could be your cash deposit or it could be a letter of guarantee from your insurer. Whatever it is, the exact amount actually varies from hospital to hospital and from case by case basis. But the key idea is this. Before the treatment even begins, money already starts becoming part of the conversation. And this is where your insurance agent comes in. They should help you to remove the need to pay any cash payments upfront as much as possible, because who wants to pay when you know that the insurance company can pay, right? But to be honest, not all agent does this. Most of them actually just helps with the claims. So that means you have to source for your own specialist, make sure it's your panel doctor, and then at the end of the day, they'll just do the claim. For me, linking up my clients with the hospitals and specialists matter even more. At the end of the day, why they buy from me is the trust, the kind of service. And that's what my clients really like. I provide exclusive services even during emergencies, as well as providing avenues for them for some cost savings. And that is why having a financial planner that does not just sell you policy matters. So after all the administrative stuff is done, you can proceed with your procedure. And once done, the total bill will surface. And let's say, for example, it is around $80,000. Now, here's the part where most people misunderstand. Insurance does not take over immediately when the bill is out. There is actually a clear order of payment. So step 1, the deductibles. Deductibles, in other words, is the first portion of the bill that you must pay every policy year. Think of it as an amount that you must settle before insurance actually starts helping. So for example, if your deductibles is $3,500, you must pay that first. Then from the $80,000 bill, that leaves you with $76,500. And then step number 2 comes in where your insurance pays the bulk of it. So after the deductibles, the insurance steps in and pay most of the remaining bills. In most cases, it is about 90% of the total amount without the riders, and we'll talk about that in the later part. This is the core purpose of your hospital insurance. It protects you from the biggest, scariest part of the bill, 90% of it. Then comes step 3, which is the co-payments. So while insurance covers 90%, we still have that remaining 10% that you still requires you to pay. And this remaining is called the co-payment. So 10% of a $76,500 bill will amount to $7,650. So in other words, if you don't have any riders, you just get the base private hospital plan with a deductibles of $3,500 plus the co-payment of $7,650. Wow, it's a mouthful. Anyways, a total amount is actually $11,150 out of pocket. And for most families, this is a very significant amount of money. And that's why riders exist. Riders are introduced because even with insurance, you still have to come up with the deductibles, the co-payment. And this is actually a lot of money when it comes to a very serious, big hospital event. And so, the original intent of the riders is simple. To limit how much cash you have to take out from your own pocket when something big happens. And if I were to go back to my McDonald's example, you have already gotten the meal and now the rider is like your mommy or your daddy that steps out and say, okay son or daughter, let me help you to cover the rest. Just pay $5 and I will cover the rest. And so riders, in other words, are not meant to make hospitalization free. They are meant to cap your damage. But here's the uncomfortable truth. On average, most people are not hospitalized very often. Yet, riders tends to be expensive and they are paid every single year. Many people are paying thousands of dollars in premiums for their riders even without ever claiming a single dollar back. And this is the tension that MOH started to notice. The intention of the insurance or riders is to reduce your cash shock to your portfolio. But over time, the system drifted into something else. Anyways, I will pause this part here, and in the later part of the video, I will explain why MOH stepped in, what problem are they trying to fix, as well as what changes affects different groups of people. I will come back to the McDonald analogy later on as we talk about the policy changes as well as the riders more in details. But for now, you roughly understand how the bill is being paid and where your own money comes in. The next question is this. Why do most people still choose to buy hospital insurance and why most of them still choose the private plans in the first place. Now, people don't buy insurance because of the small clinic bills. Nobody buys insurance for their $30 GP visits, but they buy because of fear. The fear of having to pay a big bill, fear of burning your own savings, and finally, the fear of destroying your retirement plans. So at the end of the day, private plans are popular because people want options, not luxury, options. Shorter waiting time, choice of a specialty, more certainty. But there is another reason that is not often talked about. And let me share this with you from a parent's perspective. I have 2 kids myself, and yes, I also bought private hospital plans with the riders for my kids. Not because I want them to stay in a luxurious place, enjoying the lobsters or the beef sticks, but because when it comes to my kids, speed matters. When something happens to them, I want the fastest access to the right medical professionals. I do not want them to delay the treatment, I do not want uncertainty, and I don't want my kids to suffer while waiting. Because at the end of the day, I don't want me or my wife to have that guilt if our kids was to have any complications from those delays, because that will ruin their life and mine too. And that is why for myself as well as my clients, I have certain hospital support, access, as well as coordination privileges to make A&E visits as well as hospital administration smoother. And to be honest, when it comes to your kid, these things matters more than anything else. There's also a very practical reason why many parents do this. Children hospital plans are relatively affordable for most families. Premiums are much lower, the kids' health risks are lower, that's why the cost to benefit trade-off makes sense at a younger age. And finally, as a parent, I think of a long-term view. Buying a hospital plan for my kid is also about insurability. I would rather secure a plan for them that they may never need to use than to wait for a point in time in the future when they need that coverage, they can't get it anymore. The tricky thing about insurance is this: you only can buy this when you're healthy. Other than that, you have exclusions, you have rejections, and that makes things worse for you. That's why for insurance side, it's always better to buy something that you hope you never use than to want something later on and realizing you can never buy. This is actually leading to a very big problem. Because here's what's the data showing. More than half of Singaporeans who pay for a higher coverage still choose to go to subsidized wards when they are hospitalized. Even among people who have bought their private hospital plans, actually less than half goes to private hospitals. In other words, people are paying for the private coverage, but they end up still using a public healthcare. Sometimes it's because the follow-up care is cheaper, because the public hospitals are fastest in the emergencies, and sometimes it's because the final bills in your private hospitals are uncertain, or it could be that you're staying nearer to a public hospital. Whatever the reason is, public healthcare is still doing most of the heavy lifting. And when you see this kind of behavior, combining it with a medical cost that is rising, that's when the premium starts to spiral. Because medical costs are rising so much faster than the normal inflation. You got new technologies, new drugs, an aging population, and also a higher manpower cost. These are problems that we are facing with the medical side of things. But MOH also realized one other issue. Because when insurers introduce things like riders that makes out-of-pocket payment too low, number one, patients may overconsume, and number two, providers may overservice. And that's what abuse of the insurance is all about. And data have proven this. People with riders are more likely to claim, and their average claim size is higher. When claim rises, naturally, premium will rise as well. But this phenomenon is no one's fault, because when you're paying for something good, you expect something better, and when you know that you can claim, likelihood of you claiming will be higher. But at the end of the day, this hurts the middle class the most. And before I explain this part, just a quick heads up, this is going to be sounding a bit technical, but stay with me because this part affects your monies directly. So in 26 November 2025, MOH announced these new requirements for IP riders, specifically for private plans. There will be 2 changes happening from 1st April 2026. First, new riders cannot cover the minimum deductibles. And number 2, the minimum co-payment cap actually increases. Instead of capping your co-payment to 3K, for example, it is increased to 6K. So if I were to bring back the McDonald's example earlier, where previously your mom agreed to pay for the remaining bill after you paid that $5, now in this case, you have to pay $10, then your mom will offset the rest. You still get some support, you're still protected, but you are not completely disconnected from the cost anymore. The intention is not to remove protection, But the intention from MOH point of view is to restore the cost awareness as well as the sustainability to pay your riders for the individuals. And then comes the next part, where a recent news actually talked about how almost all the current riders in the market that will be stopped being sold from 1st April 2026. Because out of so many of these riders outside, only a very small number actually meets the requirement. And in that news, they stated that most insurers will replace the entire riders lineup. And this is why, with that kind of news, it's natural for many people to feel confused and anxious. But don't worry, because the next part is where we will be dissecting down what each category of people needs to do and what they should look into. So now, let's bring everything together. Now that we understand how hospital bills are paid, why rider exists, and why MOH steps in, the next question is very simple. Which group are you in and what should you actually do? So if you belong to category number 1, you have never bought a private hospital plan or a rider before. Firstly, let me just clear up some common fears. You are not uninsured. You still have some protection from the MediShield Life. This is not a fear decision. This is just a matter of preference. Then the real question is this. What trade-offs are you comfortable with? Are you okay with the subsidized wards? Are you okay with the waiting time because it can tend to be longer? Or are you okay with the higher out-of-pocket? And finally, are you okay with the limited coverage? There is no one-size-fits-all answers here. What matters is that you choose intentionally, not reacting emotionally. It doesn't mean that you must get a private hospital plan, because if you're somebody who doesn't like to be alone in a room, quiet or alone, then having a room that you share with other people actually makes sense. Then let's move on to group number 2. If you have bought your hospital plan and riders before 26 November 2025. So if you are in this group, you have bought the following: a private hospital IP, and your policy is bought before 26 November 2025. Now, let me address the biggest fear for this group. You don't need to worry much, because from now till further notice, your current protection from your hospital plan as well as your riders, they are not cancelled and they will not be affected in the meantime, even after 1st April 2026. The catch is this: as long as you continue to pay the premium, you will still get your perks like no need to pay for your deductibles, and your cap for your co-payment is capped at 5%. Again, your exact coverage really depends on what your riders as well as your base plan covers, but in general, this is it. Whatever that's stated in the policy document will remain. So you don't need to worry, but then, here's the truth. You are likely unsure about what kind of coverage you have, so you need to ask yourself 3 things. Number 1, what is your coverage? Does it cover your deductibles? How much of the co-payment you need to pay? And is there a cap to it? Number 2, does your agent help you to provide medical supports like linking up with hospitals for emergency as well as any other perks if you're hospitalized? And finally, number 3, you need to ask yourself, how much are you actually paying every year for your private hospitalization protection? After these 3 questions, if you're not sure about what coverage or what perks they have, then it's about time for you to meet up with your financial advisor to do a review. If you have no one to look for, don't worry, because you still can look for me. But anyways, the focus for this group of people here is on reviewing and understanding without rushing into changing your policies blindly. End of the day, your plan's coverage will definitely be more extensive. So it's about a matter of value for money as well as the sustainability of paying for these riders. And lastly, group number 3, you have bought after the announcement on 26 November, or you're planning to buy one before 1st April 2026. So this group of people tends to be young adults that just step out into the adult world, or the parents that are about to deliver their kids. And to be honest, this group of people are the ones that I'm sensing the most uncertainty, the most confusion, and the most pressured, because there's deadlines, there's headlines, and it feels like you have to decide now. If not, you lose something forever. So let me simplify what this means for you if you belong to this category. If you are in this category, the reality is this: you will eventually be on the new IP riders that complies with the MOH revised requirements. This part is unavoidable. So insurers will roll out the new riders by 1st April 2026. So if you have bought your policy after the announcement, you are already told upfront that there will be a transition to a new compliant rider. So there is really no need to rush or panic, because you just need to follow suit. You simply just continue to enjoy the coverage you are paying for today. So if right now the coverage covers your co-payments as well as your deductibles, then you still enjoy it until there's a transition happening. Then you just need to hop on to a new rider. Now there's a part of this that many people overlook, because when MOH come with this, number 1 thought is this: I'm paying for so much, but now my coverage is actually reduced. And this is where we need to understand the intention of MOH again. The end idea is that you have less coverage, but it also means that your premiums that you're paying over time will also be expected to be lower. So in other words, you're not actually losing money, you're just paying lesser for protection that is designed differently. And this actually creates an opportunity for you. This savings that you have at the end of the day should be redirected towards your future or for your kids' future. So this means that you can build up your emergency funds, save for your retirement, invest for the long-term growth. So for now, just need to wait for the new riders to be released, understand what's the trade-off, and also find out for yourself what can you do with this cost savings. At the end of the day, no matter which group you fall into, the goal is the same: clarity over panic, understanding over rushing, and long-term sustainability over short-term comfort. This is exactly why these changes matters. Yeah, so for me personally, I believe that MOH is trying to fix a system that is becoming unsustainable because a lot of people are dropping from their coverage and riders. But end of the day, insurance should protect you from shocks, not to remove the total cost completely. But what's lacking is the education part. Education is critical. So without understanding, people will go into confusion, panic, overbuying, and even cancelling wrongly. When these changes appear, the issues doesn't lie with insurance company. It lies with you and me. We buy our McDonald's, we buy our phones because we want it. That's why we are willing to spend that amount of money for a purpose, either for a fulfilling meal or the satisfaction from owning the best phone in the world. And when that meal or the phone becomes too expensive to you, end of the day, you still can choose not to buy it. Or maybe you just buy the a la carte burger or the downgraded versions. And this mindset should be the same for your hospitalization coverage. Right now, you might have the capability to opt in for a private hospital plan. That's why you got it. And because you want to pay lesser when you're hospitalized to mitigate off the big bills, that's why you got the riders. And along the way, as you grow older, your risk of getting hospitalized actually increases as well. Because of that, your premium increases with age. And by then, if the riders, the premiums gets too expensive, you can still downgrade. No one, not even insurance company, your financial advisors, or your parents can force you to keep paying for something that is not sustainable for you. It just doesn't make sense. But end of the day, when you can afford and you're willing to pay for it, it's just a matter of whether you want it or not. So, if you remember only one thing from this video, let it be: hospital insurance are not meant to make hospitalization free. It's just meant to protect you from the big bills that's going to derail you from your life. So, don't walk away from this video with fear, walk away with clarity. Know what you have, know what you want, and know how much you can afford to pay for long term. And yes, having options is good, but only when you actually understand what you're paying for. Because what we want is not more insurance. What we want is the peace of mind that we can actually sustain. And now that you know what these changes means to you, share with your families, your friends, so that they too can understand these changes from MOH as well as what it means to their coverage. Alright, my name is Jia Xuan, and I will see you in the next video. Bye bye!
We're on a mission, breaking chains. Goodwill's here to change the game. Empower your life, build your dreams. Financial freedom.